Hello, this is Julius from Basic Financials. I'm going to talk a bit about renting out residential property and the tax consequences of that. There are other things to consider as well, but this is mainly based on the taxation side of things. So let's say you have decided to buy a residential property that you're going to let out to somebody. Now, the first thing to do is to establish the difference between capital expenditure and revenue expenditure. Capital expenditure is the cost of the asset. So basically when you buy the property, that is the capital expenditure. And that cost is not allowable against rental income. It's allowable against the proceeds when you eventually sell that property, and is used to calculate capital gains tax. So when you sell the property, you look at the sale price, take off the costs of sale, for example, legal fees, estate agents' fees, and then you also take off the cost that you've just incurred in buying your property, and that will also include stamp duty on that cost and the legal fees on the cost. Revenue expenditure, that's things like if you have to replace tiles on your roof because they've been blown off in the wind, or been some need redecoration, or any damages to things, and your annual gas safety certificate, things like that. Those are revenue expenses, and they can be claimed against your rental income, which is subject to income tax. So you would have your rental income, take off your costs, and that gives you a rental profit, which is subject to income tax. Now, one important thing, let's say you buy a property that is not really in a fit state for renting, so you might get a bit of a discount on the purchase price, and then you do some work to get it into a fit state. Now, that work that you carry out, although it might seem like it's repair work, it's actually regarded as capital expenditure. You want to keep details of that expenditure along with the cost of the property, because it won't be allowable against your rental income, but it would be allowable against the proceeds when you come to sell the property as part of the cost of the property. That seems reasonable. If you're getting a discount on the purchase price and then carry out expenditure to get it into a fit state, then that seems reasonable. That wouldn't be allowed against your rental income. Instead, it would be part of the cost of the property. So that's the distinction between capital expenditure and revenue expenditure. Now, from the point of view of telling HMRC about the fact that you're now renting a property, the rule is that you need to tell HMRC by the 5th of October following the end of the tax year in which you started renting that property or started to get an income from it. So for example, let's say you start renting you buy your property in June 2018 and you start renting it from the 1st of July 2018. That is within the tax year to the 5th of April 2019, so you would need to tell HMRC by the 5th of October 2019. And the reason you do that is because they will want you to start completing tax returns. So the way you tell HMRC, the usual way now, is to register online. So to register with HMRC, you will go online usually. That's the best way to do it rather than phone call. Register for a government gateway account, and you'll be registering for self-assessment on the basis that you have rental income. So you're not self-employed, but you have a source of income that needs to be taxed. Now, what will happen is once you get your government gateway account, and you register for self-assessment, they will send you a 10-digit unique taxpayer reference, and you'll need that for the future. Now, it could be that you already prepare a self-assessment tax return, in which case you don't need to tell them about the rental income. You just need to include that rental income on the tax return you already do. So if you're already set up for self-assessment, either because you're self-employed or because your income's high or you've got unusual circumstances, you don't need to do anything extra other than to make sure you include the rental profits on your self-assessment tax return. Now, getting down to what you can include as expenses against your rental income, when you start renting, you may well have some costs that you incur right at the beginning. For example, you might buy a bed, you might put in new carpets, you might put in some fridge and a freezer, a television. Now those expenses aren't allowable when you first buy them, but in the future, if you replace them, they will be allowable. That's called, I think it's replacement of domestic items relief, I think it's called. So that's worth bearing in mind. So can't claim it as an expense first when you first buy them, but you can after that. Now the sorts of expenses that are allowable are your general maintenance costs, such as, I think I said before, your annual safety check for the gas. If you've got leaks or anything that you repairs, but even things like replacements of toilets or replacements of baths. What's important to say is it's basically, it needs to be a replacement. Anything that's an improvement is regarded as capital expenditure. So if you built an extension onto the back of the house, that would obviously be an improvement. So if you try and think to yourself, is it something that's increasing the value of the property rather than maintaining the value of the property? If it's likely to be increasing the value of the property, then that's likely to be a capital expenditure. Keep a note of it, because that will be allowable against when you sell the property. But if it's just a replacement, you can claim it against the rental income. Now, mortgage or loan interest and other finance costs are a bit of a complicated one. It used to be straightforward in that if you had a loan to buy that rental property, you could claim the interest against as an expense against your income. Not the whole repayment. If there's capital repayment and interest, you'd only get the interest element. But often you'd have an interest-only mortgage when it's a buy-to-let mortgage. Now things changed a little bit from 6th of April 2017, I think it was, 17, in that the idea was to stop higher rate taxpayers getting relief for that interest. So it's basically to stop people going out, getting a loan for buying a property, covering the loan with the rent, and getting full relief effectively. They don't. HMRC wanted some tax on that sort of arrangement. So what they said is, okay, we're going to phase out relief on interest payments, other than giving you a 20% deduction against your tax bill. So the aim is, and this will happen from the 6th of April 2020, your interest relief, you don't deduct it from your rental profit, but if you've got tax to pay on your rental profit based on that profit before thinking about that interest, you can take the interest you've paid, take 20% of it, and you will be allowed that as a deduction against your tax bill for the rental income. If you didn't have a rental profit, then you wouldn't be able to get that deduction because you haven't paid any tax on your rent. What you would be able to do is to carry that 20% forward against future tax bills on your rental income. Now they're phasing that in. So it started off at you had 25% where you could, or 75% you could actually claim against your income as a profit, as an expense rather. Then it's this current year up to the 5th of April 2019, it's 50%. Then it'll be 75%, and then all of it. So, in other words, at the moment, you can claim for the year to the 5th of April 2019, you can claim half of the interest against your rental income, and the other half you get a 20% deduction from the tax bill. Now that's a little bit complicated, but unfortunately that's the way it is. Now there is something else. If your income from rental profits or rental income rather, not profit, if the rental income is £1,000 or less, you can, or close to £1,000, you can, rather than claim actual expenses, you can claim a deduction of £1,000, but you can't claim it as well as expenses. You either claim a £1,000 deduction or you claim your actual expenses. So obviously if your expenses are less than £1,000, you'll want to claim the £1,000. If you're letting it jointly with somebody, you each get that £1,000, which is quite useful. If you find that you make a loss, you're probably better off not claiming that £1,000, because you can't make a loss with the £1,000. You can only claim up to the amount of your rental income if it's less than £1,000. What else? There's something called rent-a-room schemes, so that's slightly different. If you're renting a room in your house, or part, not necessarily a room, if you're renting part of your home and you're also living in there, then you can claim rent-a-room relief. So that's slightly different from buying a property and renting it out, but that is actually £7,500 a year. So you can get income from your home by renting it out to somebody else while you're in there, and claim up to £7,500 a year, and without paying any tax on that rent. You don't get it if your husband and wife say living in the property. You don't each get that. It's only per property. I think that is probably all for now. There's quite a lot on HMRC's website about how you work out your rental profits, how to register with them. It's definitely worth reading. It's a lot clearer, HMRC's website now. So yeah, good luck with that, and like and subscribe as usual, and I'll see you again soon.